Hi, good evening. Thank you very much for joining us for this webinar. I can see there are a few people still joining us now, so I'm going to give it a couple of seconds and then we'll jump straight into this. Today's webinar is from Sourced Franchise, so from our HMO partner side of the business, and we're going to be talking about HMOs, their opportunities and the risks in 2021. I can see a few familiar names popping through, so thank you very much for joining us, guys. Hope everybody's well. I mentioned a little bit earlier on that there is a function where you can ask questions. So if you do have any questions at any point throughout the presentation, please feel free to type it in to the question section, and I'll jump on and off those to answer them as much as I possibly can. So tonight's webinar, we're going to touch on. First of all, we're going to give you an introduction into myself. So my name is Stephen Moss. I'm the Managing Director of Sourced Franchise. I'm an experienced property investor, so I've had the luxury and the opportunity to do lots of different types of structures and strategies, new builds, conversions, HMOs, and buy-to-lets. So big variety over a sort of 20-year period. I've founded it and grown other businesses that I've exited out of before founding Sourced and developing into the group that we are today. I created and launched a phone app, which appeared in the top 10 Sunday Times best phone apps. So I enjoy technology, property, they're kind of two key areas. So a property related phone app was a big tick in my box. Really pleased with that. And I'm developing over £200 million worth of property. So we'll probably touch on some of our developments that we're doing across the UK as we go through the presentation. But the main key area for tonight is talk about the HMOs, what those opportunities are, and what the risks are as well in the world that we're in today. So we'll touch on them. So yeah, to give you a bit of an overview of our business Sourced and where we are, where we've kind of come from. We initially launched our pilot scheme in January 2017. We launched our franchise model in September 17. In August 18, we were FCA approved for lending. By October 18, we'd hit 40 franchisees, so some really good growth. February 2019, we launched our largest property development, which is £150 million. By March 2019, we were approved for ISA and pension funding. So again, access to bigger pots of money to do more developments and support our franchise network. September 19, we launched our care side of the business. So working in the care sector and providing properties for people in those needs. November 2019, we hit 60 franchisees. January 2020, we were raising £1 million per month on our peer-to-peer platform. And July 2020, so middle of last year, we hit 100 franchisees. So quite a big milestone in the 3-year period. So just over 3 years now, the business has been operational. Yeah, some really good growth, I'm sure you can appreciate. Our model, so how we're actually set up, we're split into 5 divisions. So we have property, capital, developments, care, and franchise. The property side of our business helps property investors to grow and build property portfolios. We've got our capital, which is our peer-to-peer side of the business. So investors can invest into peer-to-peer and receive a fixed return with the first charge security on a property. We've got our developments. So we have developments across the UK, particularly flagship developments in Manchester and Liverpool. We've got our care sector, which we touched on earlier, where we identify properties and adapt them for the care industry. And then we've got our franchise model as well. So franchise model is now sitting at about 140 franchisees. And that's a mixture of our network franchisees and our partner franchisees. And this evening, the presentation is brought from our partner, our HMO partner franchisees. So it's a HMO very much that we're focusing on the returns. I mentioned earlier about the presentation. We're here today to cover the risks and opportunities in 2021. When we sat down with the team and we started looking at, okay, what content can we deliver? How can we help and support our community? We thought this was quite a good subject, given there's lots of changes, there's lots of unknowns in the market. And more importantly as well, it's important to look at actually what's been achieved over the past 12 months by our existing franchisees as well to say how are they getting on, how are they actually developing. So we've just had a quick question from Michael. Michael works in the care sector, interested to learn more about Source Care. So fantastic, Michael. We'll have all our contact details at the end. If you've got any questions or queries or you'd like to understand it more, please feel free to contact us. I'm sure we can help. So start of 2020. So 2020, obviously only 12 months ago, does feel like a lot longer than just 12 months. What did the market look like? So at the beginning, we had Boris elected, general election, giving stability to the market. We had Rightmove reporting a 19% increase in buyer inquiries. So the property market was on the up, looking confident. We had this threat of COVID looming in the background. It was kind of slowly building momentum. And then we started to have market researchers on the back of that, and again, property related, to start commenting on what their expectations were and how they saw a drop. And a lot of people reported up to a 20-25% decrease and drop in property value. I think it's really important. If you look back at our social media at that time, we were very much the opposite, to explain to people that there are opportunities. It was a little bit, we talked a lot during particularly the middle of the year, where we talked about the sort of Christmas effect, how, you typically find that the market booms in January, February, the property market, because people are locked up at Christmas and they realize they either need a big house or they go separate ways, etc. And this was very much a kind of knock-on effect for lockdown as well. So in the first lockdown, what did we see? We saw what was quite a large property mortgage market for first-time buyers at 10% mortgage deposits. Over 650 providers dropped massively to less than 60. So these were the sort of fuel, if you like, that were being added to the fire of people's predictions of markets reducing and property reductions. We had investors panicking in terms of not being able to attend viewings and valuations, in particular at standstills. Again, a lot of people talking about a crash and where the market's going to be, and potentially a crash of 2008. And as I mentioned earlier, we really didn't see that effect. We saw some stalling in the market, certainly when people were unable to do viewings and valuations. We all actually saw a really good market when we came back out of that. The government announced a job retention scheme and mortgage holiday for landlords. I think, again, helping to support not just the property market, but other markets as well. I think the government realised just how important the property market is to the whole economy. Post-lockdown, so, coming out on the other side of the initial first lockdown, new homeowners were able to move. We all became DIY experts. Not great DIY experts in my case, but still DIY experts. People that planned to move found that they needed more space. So again, this kind of feeling of being locked up, and again the effects predominantly in the property industry known as the sort of Christmas effect of being sat at home and needing more space. The stamp duty holiday was announced, and I know at the moment there's a debate on whether this is going to be extended, and we're hoping to hear very shortly. Mortgage approvals rose to the highest in the 13 years, with interest rates as low as 0.1%. So again, really good kind of, I suppose, key drivers in terms of what's there and what actually happened when we came out of the first lockdown. The second lockdown was very different. It was a much smoother market stability. The construction industry continued. I think people were a bit more aware of what was going on and space around them. And it's quite an interesting point as well. We develop a lot of property across the UK. One of the key areas we found in the first lockdown was actually materials. We're finding at the moment that it's not so much being able to get materials. We're actually finding that the difficulty we're having at the moment is delays due to the EU. So it's not actually the lockdown situation and COVID. It's more bringing goods in from the EU. So that's a different approach, I suppose, more than anything else. So towards the end of 2020, where were we as a business, to kind of give you a snapshot? As a business, we doubled in size, which is fantastic for the number of people working with us on our team. We'd raised more than £10 million in projects. So we were actively funding projects throughout last year for our franchisees. We had 100% repayment rate, which we're very proud of. So we make sure that what we're lending on, we're able to repay our investors. We saw a 20% increase in property leads. So interestingly, that's continued to increase already this year. So, whereas we thought we kind of had this mini boom by people being locked up, and we were expecting this to drop when we came back after Christmas, it's actually continued to grow, which is good. Kind of snapshot of what some of the banks and the big players in the property industry were forecasting and where they were as well. So you see here some of the trends. So Halifax are always quite prominent and do shout a lot about their growth statistics. Sometimes a little bit out, but quite often they're used as a kind of guide. And they're talking about an annual price rise of 2020 7.6%. So it's actually the opposite of what we heard at the beginning of the year. And I think this is quite an important key element, because we're at that stage again. We're at the beginning of the year and we're already hearing people feeding these stories through to say there's going to be this huge crash, there's going to be this huge problem. And we had that at the beginning of last year. It's interesting now to look at the results. Halifax are predicting a reduction of -2% to -5%, which they did incidentally at the beginning of last year as well. So it wasn't quite -5, but it was a minus reduction. We've got Rightmove, who are another good indication, because they're actually at the other side of the spectrum, and they're actually predicting a growth this year of 4%. So it'll be interesting to see how that plays out, and I'm going to touch on what our predictions are as well for this year coming. Current risks in HMOs. So whole presentation is about HMOs, and we've looked at the market first of all and what happened through COVID. A lot of people we were speaking to, so obviously we took franchisees on, joined us throughout the COVID period last year and this year, and a lot of people that did that, probably their kind of key hurdle was ultimately, what can I do? What can I do in this market? What can I do in this position? I think it's really important to look at, what are the risks? What are the opportunities? And we've kind of listed some here, and these are ones that we were openly discussing with people about what's changed in the market. We've then gone along and spoken to a couple of our franchisees that look and focus in the HMO market, and ultimately what have they achieved, what have you achieved over the last 12 months, and ask them some kind of key questions. So we're going to explore that a little bit more and delve into it. So HMO risks. First one, obviously, a higher level of legislation and planning compared to buy-to-let. So this year in particular, there's a lot of changes coming into play with planning permission. So we've got permitted development, which is being removed. We've got changes that we're waiting for approval. We've got new room sizes or minimum room sizes, which, again, this side of the market, particularly HMO, play a big part in it. Fewer mortgage providers. So we're generally seeing that mortgage providers are returning to the market, but they're doing it typically in their own speed, at their own rate. So again, it's something that's a risk as a HMO developer, HMO owner. So it's important that, when you're planning this, you understand that ultimately, can we exit if it's a conversion that you're looking to do? Larger deposits may be required, especially for first-time landlords. So, and again, another key area that we speak to a lot of landlords about, people you may have done this yourself, where you've spoken to mortgage brokers and said, I'm looking to buy my first HMO. What's the situation, or what's the position for the refinance? And you'll often find then if you turn back to speak to them, they're running away with their hands in the air, because the impression is that you have to already have buy-to-lets, you have to already have HMOs. It's about how you structure it. Ultimately, what you need to do, and it's a little bit more expensive, but when you're bridging a property, and if you're doing a conversion as an example, then you need to give yourself time to tenant the property, to manage those tenants, and quite often the additional rent coming in can cover the cost of the bridge, so you can work it out in that way. But ultimately, what you're doing is you're providing evidence to mortgage companies that, look, I can operate this. I've been operating it for 6 or 12 months, and prove it in that way, rather than just be concerned that actually I can never get on the HMO ladder because I'm still waiting for my first one, or I'm waiting for these huge deposits that people are talking to me about. Higher startup costs. Yeah, absolutely. We're seeing this across our developments, particularly so the conversion. Furniture, not so much as yet. I suppose it really depends on what stage you're at. But certainly, we're finding again we just had a really good example. We're converting a block it was an office block to apartments. Really small things. So, stop taps. We've got 4 stop taps in each property, each apartment. Stop tap, the particular type we were buying before was about £9, £10. It's now costing over £30 for these stop taps because they're being shipped in, and that's the increase in price. So little things like that can start to add up quite quickly. So it's being aware of it and making sure that, again, if you're doing a conversion, when you get the bill costs in from the developer, from the actual builder, you need to make sure that you're getting that fixed price lock-in, so that if there is a price increase on certain materials, then it's the builder that has to cover that, not yourself. Fewer letting agents taking on HMOs. I think it's a real mixed bag depending on the area. So we're finding in some areas actually letting agents are moving into this sector because they're seeing it as being a growing sector due to travel, etc. Some agents, they're closing their doors to it and having more of a focus on family or buy-to-let properties. Capital growth could be lower on HMOs. I mean, this is a typical HMO risk when investing in A-type. It's not really just on COVID-19 or the market as such. I think that the biggest key point for this is really it's not so much as a huge concern. If you're investing for longer period, then fantastic. You'll make that growth up. If you're converting the property, then the increase in value will typically outweigh any reduction on property growth as well. And finally, one of the points in this, that the risks is not every property can work as a HMO. There are a number of suitable properties, but it can be limited. So quite often when we're working with franchisees, and I mentioned earlier that we have around 140 franchisees in the Source network, quite often you can find people are trying to make deals or property fit into deals rather than actually reviewing it, having some key points that they review. If it fits those key points, you then move on to the next stage. If it doesn't, you leave the property alone. And it can be a little bit time consuming. If anybody on the webinar has gone down that route and spent hours and hours chasing or looking at particular costs, you'll know the pain, and we share the pain that you can go through. But ultimately, that's really where training comes into it, to be able to look at a property, look at 4 or 5 key points and say, right, okay, yeah, this has got potential, or no, this one just won't work, and let's move on to the next one. And it's having that experience. Supply and demand, obviously key elements, making sure that you're purchasing with as much discount as possible or conversion built in into the actual cost of the property as well. Opportunities, so HMO opportunities. So what are the opportunities this year, 2021? Rental yields can be much higher. So there's a lot of press at the moment talking about demand for rental, talking about co-living. So co-living, one of the things that I love about HMOs is how that market changes. Quite often you meet people that when you talk to them about HMOs, they might have a perception of a HMO where it's kind of this building with 50 bedrooms, 1 kitchen, 1 bathroom, and in the morning you wrestle through 49 people to go to the shower. But in reality, that market has changed over the years. So you've now got this nice market of ensuite facilities, feature walls, fast broadband, little touches that are constantly being added. And now even the term itself is starting to change as well, with co-living kind of growing as a popular demand, and particularly in rental yields. That's obviously helping the growth of the rental income, which again in return will give you a better yield. Less risk. So ultimately, by looking at it as a business and looking at it as an investment, if you fill 4 out the 6 rooms, then you've got income still coming in, you're still getting a return. It's easier to manage in that respect rather than the whole property being empty. Ultimately, that can result in less arrears. So, again, if you've just got one tenant who's not paying you in one property, that's a massive nightmare. If you've got one tenant out of 6 that's not paying, then it's something that you can manage. You're still getting an income. where you can pay the mortgage or and any of the bills and potentially still make some income. So the opportunities are there by utilising the structure of HMO. Most spending on HMO is revenue costing, so income's tax deductible. And it's important to make sure you've got your structure right at the beginning on how you're going to manage the HMO, where the income's going to come into, the costings for the HMO as well. So we do a training session just on this, and it works quite well. With COVID, so the trend's swaying to more affordable housing with the community. So I talked about this a little bit before, but in terms of this co-living, and co-living, it seems to be quite a key word now, and ultimately it's still HMO, but it's about having some space. And if you just look at from a commercial point of view, the growth that WeWork had by introducing this co-living, then people are kind of really jumping onto that with HMOs, and they're seeing some really, really good results. And I'm going to share with you some of the results that one of our franchisees has had, which is absolutely fantastic. Again, introducing that perception of the co-living. So I probably jumped ahead on that one a little bit too much. So yeah, when we sat down and we talked as a team about this and what we're going to present and how we're going to, explain to people, look, there is a lot going on in the world. We fully appreciate that. However, business is still there. The opportunities are still there. There are more opportunities than normal, if anything. It's about taking advantage of them. So let's have a look at a couple of guys that work with Sourced in the HMO arena and what they've achieved. First of all, we're going to look at their challenges and hurdles. So finding the right properties to convert, it's been challenging. Ultimately, it's been a market where sometimes you can't go out and visit every property. So that's obviously one of the challenges. Overinflated or overpromised figures. So because there's less on the market, you might find that agents are telling people they can achieve more because they're trying to fight for the business. Planning in particular has been probably a kind of backlash of COVID in terms of things that are taking longer, but in the same respect, it can also be to a huge advantage. So you generally find that, particularly if you're going to convert office space and utilising permitted development, then ultimately the councils only have so many days to respond to that application, or it's automatically granted. So this could really play into your palms by saying, that they've only got 56 days from memory, and on that basis, then if the council have got people off due to COVID, or they've got people working from home and there's slow reactions, etc., it's a big advantage you can take in that respect. Having investors that only want properties in the north. So this is something that we come across quite a lot. We have people that talk about the yields being better and the opportunities, and yeah, of course they're better. The house prices are cheaper. It's really down to your personal choice where you want to invest. We have some very successful portfolios in and around London that again look at the capital growth, and they're playing for the longer term, and ultimately they feel that they can earn a lot more money by doing it that way, which is quite right as well. Investors expecting an instant return. So I think this is one of the challenges in terms of you as an investor, you as a HMO investor. So quite often we come across people that are looking to buy their first HMO, convert it, refinance it, pull all their money out and do another one and do another one. That isn't the reality. The reality of it is that there's usually a small amount of money left in, depending on the size of the property, depending on the size of the HMO, etc. But we do a lot of HMOs in the north, as an example. We can refinance them and leave around £20,000 in the actual property. Probably one in every 10, maybe 15 properties, you're able to refinance and pull all your money out. But it's not everyone, which I know is taught on a lot of websites and a lot of things. In reality, we're doing a lot of HMOs across the UK, and we can see that. Reducing voids. So we're going to touch on that very shortly and talk about options and ways that can be managed, how they overcome them, and opportunities to overcome the challenges and hurdles. So different ways, creating larger rooms with the ensuite. So again, going through that phase of not just putting as many people as you can in a property and sharing facilities, actually giving them their own space, giving them their own suite, but allowing them to have some kind of co-living area that they can use, but still having that privacy. Planning laws have been relaxed in some key areas. And again, we talked earlier about how planning is going to change, particularly over this year. and it could be huge opportunities for property investors. Being realistic with investors about the returns. So this is one of the feedbacks we have from our franchisees. So quite often we'll talk to franchisees about using our funding from our peer-to-peer platform, or if it's a smaller amount, or if it's a JV, then we have our investors that we introduce to the opportunity as well. And it's about being open with them to say, look, this is the plan A, we're going to refinance and repay you this way, or plan B, potentially it'll take a little bit longer, you'll receive this much of the rent, and then we'll refinance and pay it that way. Commercial conversions. So I mentioned earlier about the plans and the opportunities in the planning sector that are going to change throughout this year. Really, really exciting stuff there. If you look out for the webinars coming from our property side of the business, you'll see that we've got webinars about planning and changes throughout this year. So really exciting stuff. Due diligence, rather than just making a deal look good. So again, I touched on this in terms of trying to get a deal to fit. It's having those key points that you can look at and say, right, bang, 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 I know these work. Does this property fit this? Yes, it does. Let's move on to the next stage. No, it doesn't. Right, okay. Let's start looking for another property and continue to push in that way. So this is one of our franchisees, very experienced, successful chap, Niraj Katir. So we asked Niraj a couple of questions, and really to give people an insight and an overview of people that work in the HMO sector day in, day out, on what they've achieved in 2020. So the first thing to understand about Niraj is he's got a property portfolio, a HMO portfolio of 195 rooms. So, huge portfolio there of HMO property rooms. Throughout 2020, he only had 3 rooms that had void periods. So his approach to this has been really refreshing. A lot of people in 2020 locked down the doors, stopped the costs, closed everything as much as they possibly could, whereas Niraj did it a different way. He repurposed his student HMOs. He invested into them. He went back into his student HMOs and reinvested into them. He changed them so that it was larger rooms for professionals with en suites. And he also spoke to his investors. So he spoke to the investors and made it, was open about the situation. Well, this is where we are. This is what we're doing. This is our plan to continue to grow our business. I can see someone's just popped their hand up to ask a question. Please feel free just to, if you want to write on there to ask a question rather than putting your hand up, it's a lot easier. Happy to jump on and answer that at any point. His expectations for 2021. He feels there's going to be a huge number increase in property deals presented. And as I said earlier, we're seeing that throughout January in particular. A change in the market, such as Shawbrook and Lloyds, reducing their lending to 65% loan to costs for the first time. So Niraj has been and I'm sure he won't mind me saying this, he's been a customer with Lloyds Bank for quite a long period of time. And Lloyds Bank have always operated on the base of, we'll lend on property up to 70% of loan to cost. They've actually just reduced it for the first time in, from memory, I think it's 25, maybe 30 years. So it's quite a big change. So it's, they're adapting their expectations. No shortage of cash investors, which is one of the reasons that Niraj joined Sourced as well, because of the investors that we can introduce him to. And his plan this year is to continue to grow his portfolio by about 15%. One of the things that I would say about Niraj is his story. Building a portfolio up to 195 HMO rooms is fantastic. So next month, we're doing a webinar with Niraj to ask questions, delve really deep into this, and we're going to share it all with you guys so you can listen live and ask any questions as well. I think a question actually just popped up, so bear with me 1 second, please, guys. Yes, this will be recorded yet, so we will send the recording out to you. So that's one question. What did you mean in regards to HMO revenue costings? So Jason, it's just really regards to structure of what you're implementing, and whether you're doing it in personal, whether you're doing it in a company, and also making sure that you can utilize the costs against the HMO. So again, we talk about the structures in our training, and again, we're going to touch on that very, very shortly. Bear with me 1 second. We've also spoken to another one of our franchisees, so Mark. Mark talked about his achievements in 2020. So he was actually quite fast off the starting line. So it's pretty much within weeks of him joining us, he funded a property within 24 hours via Source Capital. So you can see actually in this image behind him, there's a row of shops and offices above. He's basically converting the offices above into apartment stroke HMO, and he's agreed a long-term lease with a care provider as well. So yeah, 9-bedroom HMO. He's working currently on 7 buy-to-lets as well. See, a question just popped up, guys, so I'm just going to jump onto that. Apologies. Oh, no. Sorry, it was flashing, guys. Nothing there yet. Cool. How did you achieve this? So one of the questions we asked Mark, and if anybody listens out for our podcast, etc., Mark's been on a couple of our things and our webinars as well. So really experienced chap. Having run a successful property agency, you've built a lot of contacts over the years, facilitated with the support from Sourced, using the Source funding to maximise his portfolio growth. His expectations this year: huge influx of demand for professional HMOs. He's looking for HMOs either that he can put in place long-term lease agreements with care providers, and he's also a big focus on commercial to residential. So exactly like this particular project that he's done, where he's converting this into a 9-bed HMO. Right, cool, guys. Another question. Personal name as opposed to limited company. So yeah, so what are the differences or the pros and cons of owning a HMO in your personal name as opposed to owning in a company? It's mainly to do with tax structure, to be fair. We did have, about 12 months ago, we had an accountant on one of our webinars and talks, and we kind of covered different benefits, different structures, different strategies as well. I mean, to give you an example, there are lots and lots of different things that you can do and utilize, and it all depends on ultimately what your plan is longer term, whether you're converting HMO to sell it to generate a cash pot to then convert HMOs to generate a regular income. We have an ISA which also helps people as well. So as an example, you can invest into your project with ourselves through your ISA, and then when you sell the property, ultimately it means that the return is tax-free as it's paid back via the ISA. So I'm kind of giving you a little bit of an overview on that, because that's not really the conversation that we're going down today. But yeah, look out for our webinars, check through our past webinars as well. And if you've got any particular questions about structure or anything that you'd like to ask, all our contact details will be at the end. Feel free to fire an email in. More than happy to jump on a call at the end on another day when we could book it in for you. So it's not an issue. 2021 predictions. So we're looking at what's going to happen in the market. I think it's really good to utilize this. So the property investment cycle. So this one always gets a bit of a heated debate going on through the webinar. So where people think we are. Personally, if you actually look at what's happening in the market, you could argue that, and a lot of people do argue currently, that we're kind of in this stage of recovery where we're seeing that finance is becoming more available, reduction of property availability, and prices are starting to increase, which hopefully then leads on to the boom. It's a very, very strange market that we're in currently, but we'll see what happens there. One of the things that I'm going to do now, I'm going to jump into a poll. So the idea of this is so that we can share the information for everybody watching. So we've got quite a big audience on tonight. We've got a couple of questions that we've put into our poll, and it'd be good to get people's ideas. So a lot of people who watch these webinars, or a lot of people who are interested in HMOs, may have been watching this throughout 2020. So what I'd like to know from you is what stopped or slowed you down from growing your portfolio in 2020. So you should receive a question should pop up now. You can answer the question either time, capital, the right deal, or uncertainty about the market. So we're going to give that a couple of seconds, let everybody kind of lock in a vote. It's quite interesting to see, how everything's kind of changing quite dramatically. So we'll give that a couple of seconds to see what's going on. Excellent. So yeah, thank you guys for taking part in that. So I'm going to share the results. Actually, I'm going to let you all see. So ultimately, in last place was time, 6%. So in third place was capital, so the money, so that was 25%. Then we had 28% uncertainty about the economy. And the biggest one was actually finding the right deal, 42%. So I'm going to share that with you guys. It's quite interesting that as a group, almost half of you, the issue was finding the right deal. And that's quite interesting as well, because there are more and more opportunities coming through the market at the moment. Certainly we've seen a huge increase in the number of deals that have been done and the number of deals that have been assessed by our team as well. So it's quite interesting. We've got a couple more polls that I'm going to throw out there throughout this, so I probably should have started a little bit earlier, so apologies. What does the market say? So we touched on this moments ago. Excuse me. So yeah, we looked at this in terms of some of the big hitters in the market and what their expectations are. This has kind of got a couple more in there just to give it a mix, and it's a real kind of seesaw, isn't it? In terms of, you've got some there predicting up to 4% growth. You've got some that are predicting potential 5% negative. So that poll kind of showed that the people that are saying, well, we're unsure what's happening, that's probably reflected in these, really, because we're getting mixed messages from the people who are at the top, the right moves, the Halifaxes, the Knight Franks, and just ultimately, where is this going to go and what's going to happen with it. The nice thing I would say as well with HMOs in particular is that even if there is a movement in the market, ultimately majority of HMO investors invest for longer periods of time, so you're still going to have that income coming in, and you've then got a period of time for recovery if that's what's needed. We've put together some of our bods and some of our teams to say, okay, what are we expecting? We're expecting a slight price increase by the end of this year. We're expecting the number of deals secured for investors to increase by 20%, which is up from last year. We're hoping to invest and to fund about £25 million this year of franchisees' opportunities and deals. We're looking to grow our network to over 200 franchisees with 50 HMO partners as well. We're expecting a sharp increase, really, in the number of professionals living in HMOs, and I think that's just generally a sign that people are seeing it as being more acceptable. The HMO market's changing in terms of the what's positioned to people. Niraj has kind of really shared that in terms of, if you look at 195 rooms and only 3 voids throughout the year, that's a really good indication of how to do it and how to do it right. And I can't wait to share that story and some of the images of the units as well, because they're absolutely lovely. Deposits, we're going to see markets recover. We're also going to see buy to let, I think, this year in particular, coming back in terms of reducing the amount of deposits that need to be paid into deals and opportunities. And I think that'll be a big step forward. One of the key areas we want to explain and we want to touch on is obviously how we can help you. So one of the things that people mentioned earlier is actually finding opportunities. So we have a network of our franchisees, around 140, that are property sourcing and finding opportunities all day, every day, and they present them to our HMO partners. So some really, really good opportunities there. We support our partners with training, step-by-step support, proven strategies, handpicked deals, and up to 100% funding on purchase and developments. The types of returns that you can expect from HMOs. So you can expect on portfolios 10 to 15% per annum, a 30% plus return on your equity, £50,000 to £150,000 income per year, profit per property £15,000 to £20,000. So we break this down for you. So we would typically sit down and say, okay, this is how this is going to look, and this is what we're expecting to do. Quick questions just coming from Scott. Right, okay. So Scott's looking really at the structure of how he manages and lets the property in terms of charging fees from a separate company. Yeah, it's completely feasible, Scott, what you're talking about being able to do. It's just about utilizing the structure. So quite common regards to the point that you're trying to make, really, is, can I hold my properties in one company, and can I have almost a management company that charges separately? That's quite a common theme in particularly in serviced accommodation, because it's a way that it avoids you having to go into the VAT arm. So there are benefits and there are structures that you can use there, certainly that will help you run the business smoother. And again, I'll show our contact details at the end, Scott. If you want to book a call in with one of our team, more than happy to expand on that and to help as much as we can. How does it work? So I'm going to touch on this. First thing I'm going to do is one of our polls. So we had a few. How many properties are you looking to add to your portfolio this year? So if you could answer this question for us. So we've got the first one, 1 to 3 properties. We've got the second one, 4 to 8, and we've got the third one at 9+. So it's always scary when the 9+ one seems to jump up first and be what everybody's clicking. So we've got some very ambitious people on today, so which is great. I'm going to close that poll now. So you can see there, yeah, majority of people are looking to add 1 to 3 to their portfolio, so 73%. We've got the second, which is 15%, 4 to 8 properties, and then we've got the 12% of you guys looking to add 9+ properties to your portfolio, which is fantastic. The opportunities are out there. What's key if you're looking to grow your portfolio so heavily is to make sure you've got the structure, the infrastructure, and make sure you've got a clear and dedicated plan to it, because that's really important to deliver these results and to achieve what you're looking to achieve. We'll be able to show you some of our franchisees that have achieved similar and explain how they've done that as well. How our business works from a partner point of view, from the HMO partner. So our franchisees, our network franchisees, source HMO opportunities. We crunch the numbers and head office will review them and confirm that they're okay by the CRM system. We send them over to our, so they're found by our sources. They're able then to sell the opportunities for a sourcing fee. The HMO opportunities pass to the marketing team. The property is sent out to our partners before anybody else, so it's 24 hours exclusive. Partners can then either accept or reject the property. Funding calls can be set up, or they can use their own finance to purchase and develop the property into a HMO. And throughout that whole process, the idea of this is that we're here to support every step of the way. We've got a fantastic network of mentors right across the UK who are doing HMOs day in, day out. We've got a really experienced team of people at head office. We offer training events. So if you're looking to be a bit more hands-on, you can come and learn about sourcing HMOs, structuring HMOs, planning, refurbishments, lettings, lots and lots of different areas. Some of you might not want to be quite as hands-on and you don't need to come along to this training, but ultimately you've then got a team of people that can put these services in place to help and support you. In terms of the support, so we build a bespoke action plan for you to help get you going. So that's the first key area that we start off with. And then following that, we then look at ways that we can support you by making sure that ultimately you're being mentored, we're achieving your goals, the plan's working, and it can be adapted should it need to be adapted throughout that process and period. See a few more questions have just popped up, so apologies. I'm just going to jump in some of these. Yeah, so there's one there, the best way to pull my money out fast, to rinse and repeat and move on to the next deal. Ultimately, just being completely honest, it's not the best way to do this. I mentioned at the very beginning that, you need to be with HMOs to pull all your money out and to do the next deal. It's probably 1 in 10, 1 in 15 deals that you get the opportunity to do that on. Most deals that you do, you are looking to leave in, a portion of equity, and you've just got to plan for that. And that's really where the planning and support part comes from. Most ops seem to be in North Midlands. Do you plan to increase in the South? Yeah, absolutely, Colin. Actually, our highest volume of franchisees and sources actually in the South. So we do quite a few deals there. We do get a real mix in terms of some people prefer to still buy based on, even though they're based in the South, they still want to buy in the North. So it's just really what fits with your actual goals and again, your plan. A question from Mohammed: is there any restriction on HMO during the pandemic? Is it the right time to invest? It's very easy for us because ultimately I think it's the old cliche of, look, it's always the right time to invest, because if you sit there and contemplate it, you miss the opportunities. And I think that's the reality, isn't it? I think from our side, we're always saying to people, it's start moving forward, start looking at the opportunities, start the next step, and start getting involved, start surrounding yourself with the people that are going to deliver these opportunities to you, and working with these people. But there haven't been huge restrictions on HMOs other than the standard lockdown, which I'm sure you can all appreciate. And ultimately, I do feel it's the right time to invest. I do feel we are seeing so many opportunities come through, and the opportunities are really, really good. It's it's about making sure that you're in a position where you can move on those opportunities and take advantage as much as you possibly can. And that's what everybody is ultimately trying to do, and we're here to help and support that. In terms of running costs, so if you decided that you wanted to work with Source and Source was the way forward for you, then I'll kind of give you a bit of an overview of what we provide to people. You have the backing of the trusted brand and national presence, expert knowledge and support, training schedule. So we train right throughout the year. Unique funding facility, offering up to 100% funding, comprehensive support and mentoring program. And these are the kind of key elements. There are lots and lots of other things involved in being a Source franchise. And if you get the opportunity to check out our social media, you'll see and hear our franchisees talking about it, not just talking in a boardroom effect of this is great and this is what we've learned, but more about being on the on the development, seeing the things that go right, seeing the things that go wrong, and then looking at the challenges and how we overcome them, because that is the reality in property. But to join the Source franchise, it's £12,500 plus VAT. We have a management fee which provides you with tenant support, off-market opportunities, email, phones, video support, bespoke CRM, comprehensive training, access to funding, dedicated mentor, development resources, and legal documents as well. And that's £200 per month plus 5% of the gross rental income. So that's the actual franchise fee in the whole thing. So our business is very much focused on we support you as you're growing, we're growing, and that's the whole idea of it. Minimum investment. So, going back to one of the questions, can I just put some money in and pull it straight out and do the next one? In reality, you have to have a plan. You have to put something in place. So it's important to look at the areas you're looking to invest. If you're looking to invest in the north of England, we suggest that you have about £100,000 capital. So whether that's refinancing other assets or cash that you have available. If it's in the Midlands, about 200,000, and if it's in the south, about 300,000. And we will help them build a plan of around how that's going to look, how it's going to feel, and how we'll take you through that process. I mentioned earlier, ultimately we make money when you're making money. So we're here to help you and support you throughout that process. Really appreciate your time this evening, guys. I hope you've picked up some nuggets and our thoughts of where the market is and what's happening in the market. If you do have any questions, please feel free to email liam.neck@source.co. Liam will be more than happy to set up calls, answer any questions, provide further information about what our predictions are, about projects that we're working on, about everything that's happening in and around the market currently with HMOs. But yeah, thank you very much, guys. I hope you've picked some bits up, and if you do need anything or you've got your queries, please don't hesitate to reach out to us. Have a great evening. Thank you.